Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, May 24th, 2022. It is 10:39 Eastern Time as I'm starting the video. Wanted to see how the market's traded for the first hour. That's usually when you get a lot of, often a big move, a big rip or dip, and it's either going to stick or get reversed. And so I can think of no better time to do a video than right now. So let's start out here with macro. What I'm gonna do is talk about the equity markets just real quick. Start out long term. Look at a few sectors. A lot of what I've been covering, gosh, since before I went on vacation, week before last, being that a lot of key stocks and sectors are at or near support. Now, some are starting to crack, but many are still at support. And seeing a little bit some different things today, and I'm going to talk on that. It started really last night, that big drop after hours. I'll get to that in 1 second. But Snap had a bad earnings report, bad guidance, and it just really almost uncharacteristically knocked the snot out of the FANG stocks, and the Qs dropped. I can't recall a time in recent history, even with all this volatility, where I had I was long the stock futures NQ and had a gap down in the after hours session. What I mean by that is NQ shut down for an hour every day after the market closes. What is it, from 5 to 6? And the QQQ still trades, so the Qs dropped right after that. It was almost timed perfectly. And then you had over a 1% gap down when the futures open. I'll get to that in a second. And again, Snap, $34 billion company, and it took down multi-trillion dollar companies like Apple, Amazon, Microsoft. Yeah, I get it. It's the whole tech thing, visibility. Tech's not looking good. But let me get into the charts, and let's just I'll give you what I see and how I plan to react, and we'll go from there. All right, so big picture, QQQ still, the Qs. And the Qs are, I always say, to me, probably the most important index. It's not the market. You got to look at everything together. Sometimes you do have your tech wrecks, and sometimes tech's leading the market up, and sometimes it's taking it down. And because it is the biggest weighted sector in the S&P 500 as well, it's almost half of the Nasdaq 100, or over half, depending on when you look at the weightings, and about a quarter in the S&P. So it is important, and it is the market. You're not going to see the stock market, in a bull market without technology participating, at least to a greater or lesser degree. So that's it. Here's a weekly chart. Last week we did close below, and as I've covered that, we closed below support, my second target. Every other sector and every other major index I followed, the small caps, mid caps, and the S&P 500, all closed on support and remain there. So that's why, today will be telling. Let me just say that today will be very telling. Will they buy this up? So I got some charts out to you earlier. At least you could take a look at that. S&P 500 still holding the whipsaw. We're still holding the lows. Let me just get to the charts for you. So there's QQQ. That's what it looks like on the weekly. But you have SPY. Again, this is an intraweek candle, still below. So not great, because we closed the week a little below that was decent, not solid, but decent support. I said before, we may go through there. This, to me, is much better support, that long-term T1. But that was a close below, but not by a wide margin, and we're trading below right now, but the week is still young. Anything's going to happen. As I mentioned, we're also oversold, so there is certainly the possibility for the markets to get up and rally here. That's what happened when you get to the bottom of these are the biggest drops in years, or actually over a decade. These are the biggest drops. Fourth quarter 2018, 21% drop in the S&P, 36% when COVID hit, and what do we got? So, well, we know it's about 20%. The media keeps talking about it. We're flirting with bear market territory. S&P hit it intraday on Friday and then recovered above it. So I don't know what they want to declare, bear market or not, but again, that's semantics to me. Whether it's I don't use that 20% definition, at least not on the indexes. There it is, oversold. But again, oversold tends to become more oversold in a bear market, and or stay oversold for some period of time. And I've been consistent and persistent on this all along, that I believe we're in early stage bear market action. So at best, I'm looking for a bear market rally here, and And so keep that in mind with this oversold one and done. This was a just a correction in an ongoing bull market in the fourth quarter of 2018. You kissed that 30 level on the RSI and you never looked back. When COVID hit, you really hit it right about there. And there was 1 week, we're looking at a weekly chart, so there was 1 week, and actually that second week we went even lower, but then reverse. So there was whatever you want to call it, a week and a half or so, a little more downside to come. But the bottom wasn't too far, and it was explosive from there. So again, Fed had arrows in their quiver. They pulled it out. They hit the nuclear option. They don't have these arrows in the quiver. This, I can tell you right now, this, I shouldn't talk with certainties, but this cannot happen again. The Fed does not have the ability to, pull out the bazooka again. At best, they can pull out, a pea shooter right now and maybe backpedal on something on their bond purchases, or quantitative tightening, I should say, and or rates, slow the roll on their projected the dot plot, the projected increases in rates coming up. Okay, but let's move on. Let's talk technicals. Okay, so we're close there. T2, within close proximity. The week is young. And today, I think today is going to tell us. We're either going to go on. The buyers are either going to step in here now. They need to do it soon, I think. Or that's it. This level is going to be given up. And then that's going to open the door, as I said earlier, to my next targets, which I misspoke. I called that T3 on both SPY, QQQ. Don't worry about how they're labeled. That's just the next target. It was a long term. These were near term targets because all along I figured we'd do something like this. Come down, hit T1, bounce, come down, hit T2, bounce, and then go on down to T3, and it might take longer to get there. But we could just go on right on down right now. I'm seeing, as I mentioned today, signs of pretty strong signs of institutional a pivot finally. Institutions have really been slow to react to this whole thing. They've been buying treasuries today pretty aggressively, and I'll get to the treasuries in a second. So that's it. SPY. Let's see where we finish today. I'm going to get down to the short-term charts in a second, but again, this is recapping for everyone. IWM, we hit my second target, which is good support a week before last, and hit it again. Effectively tested it last week, and also we're still above it. So here's a big index, the small caps, we're 2,000 companies, Russell 2000, and that's still above support for now. So hard to write the market off until these start breaking. Mid caps, even more important really than the small caps. These are larger companies, more established. Many names you'd know if you pull the components of this index. Hit it to the button week before last, hit it to the button again last week, and we're still there. So, as I like to say, I repeat myself, I use all these little Randyisms, things I've made up. I always say support is sport until and less broken. And right now, the large caps, the large caps, including the SPY, have taken out support, not by a wide margin. So it is anybody's game, and it's hard to be. Put it this way: I'm less bullish today than I was yesterday, if that makes sense to you. So still holding the line right now on those longs, ready to pivot on a dime if need be. Might even stop the video and do so. That's it. Small, mid, large. I covered all that. Let's jump over to the shortest term charts now. Then let's look at the futures. That's what I covered this morning. So futures will tell me, especially in the short term, I like to go to the futures chart, intraday charts, because they're painting a picture showing trades that occurred outside regular trading hours along with the regular trading session. This was a distinct, clear double bottom low. You had almost an exact double bottom low as well in ES, the S&P 500 futures. That was a whipsaw I talked about on Friday. Took it down, cleared a lot of stops, and a powerful buying, and that had every making of a bear trap. But as of now, we've taken those double bottom lows out. That is not good unless NQ can snap back above there. It's not looking good now. The fact they took out that was a level that was recovered. It's 11,707 or whatever, rounded up 11,707. That should have not been violated. That doesn't look good. Now again, NQ is not the market, but you take out those lows, you're going to have more and more stops in there. I've staggered my stops. I've been hit on some. I've had staggered stops. I've been raising stops, and my last lot's going to be hit soon, and then I may be short because that low shouldn't be taken out. That one shouldn't have. This doesn't look good now unless the markets can giddy up and reverse soon. This may be one final washout. Again, I don't like what I saw after hours last night and the follow through, of course, over in the overnight session and into this morning. It just shows that supply dynamics in the market, that there's just a lot of selling pressure still there. There was a chance for the bulls to take it and run here, but when you get down here, I talk about forced margin call selling and all that. When you revisit these lows, it increases the odds of more and more selling. It increases the odds of that rubber band snapping. The rubber band hasn't snapped, by the way, yet. I'm talking, you'll know waterfall selling when you see it. This has been a somewhat orderly. We've had some big down days, but none of what I call waterfall selling like we saw back in the fourth quarter 2018, more so when COVID hit. Those are your 5% down days, followed by another 5% down day. Today's, pretty ugly, 3.6 in the futures right now. QQQ is, I'll check that in a second. Let me go to SPY real quick, or ES, I should say. So on ES, as I got out to you this morning, you had the same thing, two distinct equal lows right there at about 38.54. That's that line. Just like QQQ, you had a whipsaw down through there, followed by a strong and impulsive recovery, a lot of buying. We never were able, we took out that 30.50, but we never got that follow through buy signal. So it was certainly not a reason to be, add to any longs yesterday. I was waiting for this level. I told you 1285, 1286 to go. Lots of reactions there. It was support back here, and NQ got rejected there. That's it. And so that's still, still no reason to add on or be aggressively long unless that level gets taken out. And it still has an opportunity, but again, not liking what I'm seeing as of now as I'm doing this video. RTY, small caps, I already showed you on the weekly, still holding above support, but this was a big low right here. You had a nice bullish falling wedge, positive divergence, just like you had on the SPY and QQQ, positive divergence. Set up a little small bearish rising wedge. You hit a downtrend line. And so I think I shared this chart with you yesterday. I'm been waiting, need to see this downtrend line and this level get taken out, and that didn't happen. This is big resistance on RTY. So if we happen to reverse today, those same levels that I showed you yesterday, including this one, 1803 and the downtrend line, they need to be taken out. Otherwise, you have this previous reaction low and then that one. And if and as each one gets taken out, bears get a check mark. Take out that previous reaction low, check mark, and you're going to see more and more stops get hit. So bottom line, it's not over for the bulls yet because most indexes, all indexes, including the Qs, as I do this video, that can change quickly, they're all still above Friday's lows, and this just may be something. I'm looking at the futures. A lot of folks don't trade futures. They don't even know what the futures are. They don't care. They trade the Qs. So you want to look at that. There's QQQ. There's your recent low on a 60-minute chart. We're still above it. We hit the second target, and we still may power on through there. On the daily chart, this is what it looks like. Same thing. You're still above the lows. Let me show you sectors real quick. I'm going to kind of throw a lot of things out there, but it's all relevant. XLK is at support. You don't see it here much, but I do have dual support lines. It's pretty decent support. I'll show it to you on the weekly. This is it. XLK is the most important sector by far, without a close second in the stock market. Again, it's the tech sector. It's the largest. It's almost half of the Nasdaq 100, quarter of the S&P 500. There's all your largest companies in the world. All, most of them, I should say, that now they stripped out, like Amazon. It's not really technically a tech company, nor is, they put Facebook in the communication sector. But either way, this is a big sector here, and you have a lot of growth companies that are important, and that one's still at support right now. So If that level gets taken out, my next target or support level is all the way down at 111, and that would be, we could melt down. Market could just finally snap and get that big impulsive drop, and then before we're said and done, this is still my bear market target. This is where I think we're going. I have a high degree of confidence we're going to that trend line and/or that 111 level. It's just a matter of how do we get there. Yeah, that's another 15 to, depending again where we get there, 15 to 20% drop. And are we going to get there pretty quick, or are we going to bounce first and then get there? So that's XLK. Let me rifle through these quickly. Healthcare still holding up. This is XLV, second largest sector. There's some really good support here, about 124.63. When you look at the daily chart, you're still in this topping type pattern above that yellow line is the important level, about 124. So healthcare stocks are holding up. Financials hit my second target. This has been like a long-term short, if you will. Way back here, and I've talked on this many times, we hit my first target right away, went up, made a marginal new incremental divergent highs, they were not far enough to exceed any reasonable stop if targeting T3. So it just took a while to play out. This was a slow roll. The market top was a very slow roll for a lot of sectors. T2 was hit a couple weeks ago, and we've been dancing on it, and we're still above it, and that's support. So there's another sector above support. If it breaks, we go to my next one. It's that simple. It will break, I think, and we do go down to that next target, I believe. Do we do it really soon? Do we do it this week or next? Or does it come a few weeks or a few months from now after a counter trend rally? That's what this video is all about. XLC communication sector. This one, there it is, Facebook and Alphabet. They're considered in this sector now. Communication companies. Not technically tech companies. XLC is cracking. That's support. It's really only two companies. Not a very diversified sector because of the weighting in those guys, but there it is. So we're below support, but not by a large margin. We could easily snap back up there this day, and especially this week, or we can put it in the rearview mirror. I still think there's a decent chance we're going to bounce. That's why I'm doing this video, and that's why I want to get my thoughts out to you. I keep saying the same thing. Don't get married. I'm not getting married to my bias. I will flip and turn on a dime. I don't, I have no allegiance to a bull or bear case. Charts tell me to go the other way. I go the other way. XLV, healthcare. Let me give you a weekly. That probably shows better. Here's one, and I am seeing this. There are some sectors and some key stocks that have now clearly taken out some of my targets or support. In this case, it's 142.30, and they're headed. Remember, my targets for the broad markets, my bear market targets are probably what I should call my initial bear market targets, are to revisit the what I call the pre-COVID highs, where the market was trading in February 2020. XLY, consumer discretionary, is almost there. We already clearly taken out that 142.30 target, and we're halfway down to that level. So here's a sector getting really close. And it may do. There's no way to spin that. It's not good unless we can close the week back above that level, on or above the 142.30. But if we have a quick run down, then just keep in mind that this sector will hit a very, very good support. Probably see a lot of buyers step in there, and it's not that far really when you look at it from today's low. Only about another 2% down. So we're getting really close, and that's why I'm hanging in there with the longs for now. XLI Industrials. This is a weekly chart. Guys, I'm sorry I'm toggling through. I'm talking fast. If I don't mention it's up in the corner there, time frame, daily or weekly. Here's another one at one of my targets, 192.20. We broke this, like so many sectors. We had a big topping pattern, and then we broke down back here. We hit my first target, and last week, the week before, like so many things, checked it again, had an interweek break, but closed back right about on it, and here we are a little below it now, and with the potential to hold that level. So again, I'm doing this because I'm showing you it's not just one sector, not just one index. So many different leading stocks and key sectors are at or very near key support levels. After a pretty nice move down. And I firmly believe we're heading towards recession, maybe already started one. But I also, on the flip side, know the consumer's holding up. You guys know I just got back from vacation. Both planes were full both ways. I took two planes going out, two planes coming back. Planes were full. The hotels are full. Maui, the excursions were booked up. People are spending money. So this economy, yeah, it's not the rising rates. It's going through an adjustment period. But it's not crash time yet. And as long as the consumer's pulling out their wallet and they're still flush, you're only going to go down so far so fast. There are other dynamics in the market and what part of what's going on here and why you've seen a lot of sectors and big stocks going down, especially the big fangs. I've talked about that for years. Live by the fangs, die by the fangs. The hedge funds, not hedge funds, hedge mutual funds, index funds, pension funds, the worst. Loaded up. They in recent years, I think hopefully a lot of those fund managers, never work again for loading up on equities, overweighting. And I'm because I looked this stuff up, CalPERS and all that, shifting, more and more into equities, trying to close up their shortfall, chasing a rising market, a market that we knew had a number of days. We knew the Fed couldn't keep rates low forever. And when inflation started rearing its head almost 2 years ago, and it was a very clear and unmistakable trend, that's when the writing was on the wall. Okay, the Fed's not going to be able to sustain these uber accommodative rates forever. And so I don't think there's ever been a time in history where institutions had plenty of opportunity to decrease, pull money out, start booking profits, and they waited. They waited to the end to start pulling out of equities, and that's what this has been. So pardon my rant, but that's all. I'm trying to say from a fundamental perspective, the markets shouldn't crash right now, but they could crash just because of, again, fundamentals will matter in the long term. In the short term, supply and dynamics. If hedge funds and mutual funds and pension funds are all hitting with forced redemptions, individual investors are getting hit with margin calls, then selling begets more selling, and you could have a quick drop. But a lot of that, look at this sector. Where am I on? XLP, consumer. These are staples. Staples. Things you and I need, and they hold up in a recession. They're down 14% in just the past few months. So that's my point. And here it is. From a technical perspective, they're not there. They came close to support. My next target, 68.35. All right, I don't need to go through every sector because when we get down to the line, even energy, as good as been, REITs, they don't move the needle as much. Their weighting is too small in the S&P 500 to make a difference. 3% weighting in XLRE, the REITs. And so that's it. I showed you the big ones, most at support. I showed you the levels to watch on the intraday charts. And then last but not least, let me just talk treasuries and gold. Somebody asked a question yesterday. I forget which one, in one of the posts I made, a comment section. Hey, Randy, I'm thinking about hedging up my bonds with TBT. TBT is the two-time short version of TLT. This is the 30-year Treasury bond ETF, holds targets of the 30-year range, 20 plus. And TBT is the inverse of it, but with leverage. My answer to that is, I wouldn't, because I love hedging. I'm hedged right now. I'm doing great. My gold, silver is up today. My treasury bonds, I've told you I'm still holding on those, and I'm going to get to here we are. We're on those now. That's my hedge. I like indirect hedges. Why wouldn't I buy TBT if I own TLT? The only person that profits from that is your broker. And that's a one-to-one hedge. Why not just sell if you think treasury bonds might go down, just sell the position. It makes no sense to buy the exact opposite. It's like having SQQQ, the three-time short NASDAQ 100, and then buying TQQQ, or having QQQ and then shorting QQQ. If you think one's going to go down, just sell. Don't hold two positions. Because the other thing I talked about, it's a capital burner. What does that mean? You have a $100,000 account, let's just say, and you've got 25,000 of that into TLT, and now you go ahead, or let's say you have UBT, which is the two-time. Let's just keep apples to apples. I'm just using the comparison I was given. UBT is the two-time version. It's long of TLT. So then you want to buy, and that's 25K you have in there, right? And then you turn around, you buy 25K of TBT, which is the two-time inverse, same thing of the long bond. Well, you just burned up half your buying power of your portfolio. You've now got half your capital tied up, and it's a exact zero offset. So at best, if you maybe have a free commission broker, but some still charge commissions, you're paying commissions, your broker's happy. But I don't see the point of that. Anyways, so I said to that, I mentioned that, and I also said I'm keeping my treasuries because the charts were constructive. First and foremost, here's TLT. Told you many times that I'm not going to go into the long-term charts now, but they've hit long-term resistance levels. And I said in that reply yesterday, I maintain what I've been saying for weeks now. The risk-reward is attractive. That means they may not go up. They haven't gone up that much since I started buying them. And they went down for a while. I got in a little early, but I've maintained they back to some positive on all those positions. But it's about the risk reward. I see the downside is very, very limited because they're very, very good long-term. The interest rates are long-term resistance, which puts the bonds at long-term support, and they're up today. And that's an example of a indirect hedge. It's paying off because the stock market's down. We're finally seeing that normalization, the flight to safety. Treasuries are having a good day. TLT is up 2.3%. Again, that's the long bond. ZB, the Treasury bond futures, still looking good. So this is why I said I was sticking with these yesterday, and even though I was long equities, and it's a hedge, and it paid off. So my equities dropped today. All my treasury positions, I still have everything from the 5-year out to the 30-year. I have, this is ZB 30-year bond, looking good. Next target's up here, and again, it's sometimes, well, a lot of times I know I'm going to be wrong on things, so I'll keep this. And as I said yesterday, solely because the charts are constructive. This was a bullish falling wedge breakout, positive divergence. It's been stair-stepping higher. So I've had absolutely no reason to sell these. If anything else, reasons to add to them. Retail traders tend to average down on losing positions. Pros tend to average up on winning positions because it tells them, hey, I was right. As it goes up and as it takes out each resistance level and the charts continue to look good. Now, here's what's probably going to happen today. If the markets hold the lows and we can recover, again, I showed you the levels we need to recover on NQ and QQQ. We need to get up there and then take out those resistance levels that I highlighted yesterday. If that happens, these divergences that we have will play out, and we'll probably have another pullback in bonds. But as of now, especially with the market in equities in a very precarious position, I will stay with these right now to offset any losses. It might not be a one-to-one offset. It can be. It depends how much. I always say this: if you're going to buy bonds, especially as a hedge to equities, you need to buy a lot more. Bonds don't go up as much in percentage terms or down as much as stocks do. They're lower beta, lower volatility. So you put a larger position and you can be well offset. So again, I'll go back to TPT. Well, let me get to the other ones real quick. ZF is a 5-year, looking good. Look at that. Again, nothing's changed since this is well before I left town. These broke out. There's your nice positive divergence breakout there. Been stair-stepping higher. That's an uptrend. Higher lows and higher highs, and we just today took out that 113.164 second target. That was the first target there. It's next target and the next target there. So 5 years looking good. And again, this is something I wanted to comment. This is a flight to safety. Institutions are finally starting to move into bonds or selling stocks today. Will be a one-off thing. We'll see. Hard to say, but as of now, these charts look constructive. And then last but not least, there is that CN. Looking for the CN. My charts down below. Here it is, 10-year. So here's divergence. See, I've been noting this was something I put on here yesterday. ZN, you still have divergence. But, in a bull trend, this is a bullish fallen wedge breakout. These divergences may get taken out. I'll tell you this right now. They'll be taken out if the stock market continues to fall and we take out the lows. We'll probably see treasuries continue to rally. If the market can defend the recent lows, even if it's with a brief whipsaw down below, but if the S&P 500, Nasdaq 100, mid cap, small caps, they all take out the recent lows, there's no way to spin that as bullish unless it's a brief break, just like we had on Friday, a brief dip below, followed by a strong recovery. But I'll take it on face value. We break those lows, that's just, again, that's not good. If we get a whipsaw, I'll jump back in. That's what I did last Friday. Um, so on that whole hedging thing, TLT is up 2.5%, just to go over that, and the S&P 500's down 2.13. So that hedge is actually, and the Qs are down 3.36. Qs usually move a little more, so that hedge is paying off pretty well. Last but not least, let's talk gold. And to really talk gold, I like, and I'm long the euro. And that's going to help. That's helping gold. So I covered it yesterday. We were right here, so it's continued to build on those gains. This was a just again nice technicals, and this is only a 60-minute, nope, 120-minute chart, 2-hour candles. I showed you this low was a major, major, major long-term support level on the euro US dollar. So like bonds, like US Treasury bonds, the risk reward right now is skewed. It's very attractive. In other words, what does that mean? Well, we could have another down, and there's no guarantee that support will hold, but I think the downside at this point in the euro is limited compared to the upside potential. That's what risk reward's all about. So you have a position here. If it pulls back and you're not in it and you want to trade the euro or gold or silver, you can trade gold and silver. I like to keep an eye on what the euro is doing. That's why gold and silver have had a headwind lately, because of the euro's just been in this persistent downtrend with the dollar being in an uptrend. Now that trend, I believe, we'll see, time will tell, is an early stage trend reversal with the breakout of that bullish falling wedge here. This is a 2-hour period chart, 2-hour candles, 6 months of trading history, breakout, back test, and we're walking up. So next targets here about 108.42 and then 111.72. If that plays out, then that should continue to provide a tailwind for gold and silver. And there's gold moving up again. This is not mere coincidence. Gold, I showed you the euro had that divergent low on the 120-minute chart. This is a 120-minute chart on gold. Positive divergence, breakout, moving up. Just took out the 1858.41-ish target there, and should have more upside as long as the euro continues to rally. And remember, the euro, for whatever reason, I just like trading and tracking the euro. It's an inverse of the dollar index. Euro up means dollar down, and that's only because the euro is a 56 or something percent weighting in the dollar index, so they move inversely. There's the dollar right here, dollar futures. You had that divergent high, negative divergence right there, and a break of support, and you have a reaction high here coming up, but this is where at minimum right here is where I think the dollar is coming down to 99.34, and this intersecting uptrend line, intersecting by the time they get there, that means like, uptrend line comes in higher levels, zigzag down, come in somewhere here. At that point, I'll be, if we get there and I'm still in the euro, I'll be closing that euro long, probably reversing it to a short, and also keeping an eye on what gold and silver are doing, maybe booking some profits on those, on the metals there. Last but not least, on a related note, palladium has not broken out yet. There's that trend line I gave you yesterday. You want to play it safe. I always call it, another thing I made up, called the BOD level, benefit of the doubt resistance. 2022.69, so round that up, say 2025 should do the trick. Why? Because the downtrend line, yes, is certainly resistance, and it will probably be the catalyst for a rally in palladium if taken out. But then you also have some minor price resistance there at 2023, we'll call it. So pop that, and then you run up and hit these targets. Right now, hard to say. I'm not looking for a moonshot on this one. Just probably run up here at about 305. I gave you some targets on PALL, the Palladium ETF. If that's hit, that level is about a 14% rally or so. If that 2305-ish resistance levels hit. So I'll update it. It hasn't even broken out yet, so it's still not even an active trade. If it does, I'll let you know. Okay, I'm going to wrap it up here with just a quick loop back to the future. Still there, no recovery yet. I really would like to see a recovery back above 11707 right there on NQ. And this will be a position. I think it's still anybody's game. Market can scream to the downside or it can scream to the upside, but that same level I gave you yesterday has to get taken out. 12805, 50-ish, whatever, give or take on NQ. And so far that has not been taken out. If that gets taken out, it should open the door. I would put very good odds if it's taken out anytime soon that we go up and hit my second and third target in the downtrend line. If these lows are taken out, then watch ES. Boom. ES is not looking good. It's not. ES needs to get up, take out yesterday's high. So that's it. Let's keep it. Let's not overthink it. Watch these levels because it's do or die time for the bulls. They need to step in here and defend these lows. And if they don't, we could be a swift move down. Maybe get that final. Who knows how long it'll be, 1 day, several days this week, final washout move down to those next targets, and that's what you want to watch. All those support levels that I gave you on the daily and weekly charts of not just the indexes, but a lot of key sectors and stocks, which are still holding up as well. Amazon's still at the same support level I gave you. It hit, week before last, so a lot of those are there, and some others are breaking down. That's what I'm not crazy about, like Alphabet and some others. So kind of a mixed bag, guys. All right, so that's it. I'm staying along for now, ready to pivot, and I'll let you know. This has been Randy Finney with Right Side of the Chart. Have a great day.